Hello everyone, welcome to this video. And today in this video we are going to be discussing about the golden rules of accounting and what are the fundamentals of the golden rules of accounting. Golden rules of accounting are the fundamental principles that guide the recording of financial transactions in the double entry bookkeeping system. So these principles are based on the types of accounts that are involved in the financial transactions. So the principle says that there should be two accounts which are involved in a financial transactions. So there are three main accounts which are involved in any financial transactions, which we will be discussing in this video. So do watch the video till the end, and if you are new to the channel, please make sure you like, subscribe and tap the bell icon. There are three types of accounts that are involved in the financial transactions. The first one is the personal account. Second one is the real account. Third one is the nominal account. Now, what is personal account? Personal account is any account that relates to an individual, firm, business or an entity. Okay? And what is the golden rule for personal account? The golden rule for personal account is debit the receiver, and credit the giver. Okay, let's take an example. Suppose say I am a businessman and I sold goods to Mr. X worth rupees $100. Okay, sold goods to Mr. X worth rupees $100. Okay, let's say this is a credit sale. This is not on cash basis. Let's say this is a credit sale. So which of my account will get debited and credited? Here Mr. X is the receiver of the good. Mr. X is a personal entity now. It's a personal account. So there are two accounts that are getting affected. One is Mr. X, that is personal account, and we are crediting sales because goods are going out. So the sale transaction is pertaining to real account, which we'll be discussing later. So for now, Mr. X is the receiver of the goods. So we are debiting Mr. X by $100 and crediting our sales account to sales by 100, and this completes the financial transaction. So this is what the rule clearly says. Whenever you find a personal account in any financial transaction, you are supposed to debit the receiver and credit the giver. Okay. Now let's take another example of personal account. Purchased goods from Mr. A worth rupees 200. Alright. So here which account will get debited? As we can see clearly, there is a personal account that is involved. Here also there was a personal account of Mr. X, but this was a sale transaction, and here it is a purchase transaction. We are purchasing goods from Mr. A. So here our purchase account will get debited. Even though purchase is a real account based transactions, which we'll be discussing later, Okay, and here there is one more account that is involved, that is of Mr. A. So we are crediting the giver of the goods by rupees 200. To Mr. A, rupees 200. This completes the purchase transaction. This is an example of the personal account under the golden rules of accounting. I hope it is clear now. We will be dealing with more examples in the coming videos. For now, we will just take these two examples. So next we will move on to real account. Now, what is a real account? Real account relates to tangible and intangible assets like land, machinery, something like trademarks, patents. All these fall under the category of real account. Let's take an example. For an example, when an asset comes to the business, suppose there is a purchase of an asset, say machinery, it is a gain to the business. So we are debiting the machinery account, right? So what is the rule for real account for debit? Debit what comes in the business and credit what goes out of the business. Suppose, say, I'll take an example. Purchased machinery worth rupees 50,000 on cash basis. Okay, on cash basis. So here what we are doing is we are debiting the machinery account, debit by 50,000 rupees, and crediting cash because cash is going out of the business. $50,000 credit, right? So this is how it works. Now here we can say that it's a complete real account transactions because you can see both tangible items are involved over here. One is the machinery and another one is the cash, right? Cash is also tangible, machinery also is tangible. So we are having real account which are impacting both the debit and credit for this specific transaction, right? Similar example we'll take. Purchased furniture sold furniture for rupees 10,000 on cash basis. Okay, so here which are the accounts that are getting debited and credited? There are real account that are getting affected in this transaction. One is the furniture, second is the cash. So what we are doing is we sold the furniture, so we are getting cash. Cash is coming into the business. So what is the rule for real account? Debit whatever comes in and credit whatever goes out. So cash is coming in, so I am debiting cash account debit rupees 10,000 to furniture and equipments rupees 10,000 because furniture and equipments is going out of the business. Clear till here? So we will move on to the nominal account, which is the third golden rule of accounting. Nominal account. So nominal account relates to expenses, income, gains, losses, right? For example, we are debiting all expenses and losses and crediting all income and gains under nominal account. So what is the rule for nominal account? Debit all expenses and losses, credit all incomes and gains. Let's take an example. Example number 1 for nominal account. Salary paid to employees, rupees 20,000 in cash, right? So what does the rule say? Debit all expenses and losses, credit all incomes and gains. So here there are two accounts that are getting affected: salary account number 1 and cash account. Now cash is a real account, right? What is the rule for real account? Debit what comes in, credit what goes out. So here the salary is paid in cash, so cash is going out of the business, right? So now under nominal account we are debiting salary account debit rupees 20,000 to cash because cash is going out of the business. This is example number 1. We'll take example number 2 for nominal account. Let's say received 2,000 rupees as interest. Okay, so interest on investment we can say, right? So it will be a bank transfer. Obviously investments, whatever gains we get, it will be transferred directly to your account. So my bank account balance is increasing over here, right? So which are the accounts that are getting affected here? One is the real account and other one is the interest account, right? Interest is nominal account and bank is a real account, you can say cash, because our bank account balance is increasing. So it's something that intangibly it's a gain to us. So we are debiting the bank account debit rupees 2,000 to interest rupees 2,000. Clear, guys? So these are some examples of the golden rules of accounting. I hope you have a general idea about what are the golden rules of accounting. If you like this video, please make sure you like, subscribe and share this video with your friends. And I'll see you back in the next video. Till then, take care.